Good morning, everybody. Happy Monday. I hope everyone's doing well. We hopefully you guys can hear me. We'll get started in about 1 minute or so. So I'm just going to quickly get something moved over here, and then we'll get started. If you guys have any questions, of course, it's going to be a big week this week. So I think we need to make sure we ease into it. I think a lot of headlines, thus potentially a lot of headline risk, right? So we need to be adequately prepared for that. And that's what we are going to look at here today. I'm going to start off with the move index this morning. So we'll get started on that here shortly in about another minute or two. So I'll be right back here. Right. Good. Very good. Okay, good morning, everybody, and again, happy Monday. We've got a busy week ahead of us here, so I'm trying to ease into it as opposed to get too sort of frazzled about it. But we have a lot of economic data, including we're going to hear from Chairman Powell. We're also going to have the February labor report on Friday. And I think we're going to have a whole bunch of news coming out of the White House. Of course, on top of that, we've got the quite a shift in geopolitical stuff. I'm not sure how to best term it after last Friday's situation in the White House, and some news over the weekend already now around the Ukraine-Russia situation and all that stuff. I'm sure you guys saw the news. So I think we need to make sure we don't come to too quick a conclusion here. We need to just make sure we stay within our framework. And so I'm going to start off with a few things. As always, I've got my notepad. I've done research most of the weekend. It seems like a Thursday already today. I worked the entire weekend through. And so here we are on Monday, which really feels like a Thursday to me, or at least like a Wednesday. So let's look at gold and that market. We'll start off with the move index, which is important, and then I would like to show you guys some support areas in the S&P 500 that we are watching very closely. They bear both logical levels and technical levels, and then we'll look at a few sectors or a few parts of the market. The financials continue to hold up really well, and indeed the market rover has been signaling that for us. First of all, though, I do want to quickly show you what's going on here in terms of bond market volatility. So bond market volatility is something that professional investors watch very closely. And so what we're seeing here is, and you can even do a simple technical analysis on this if you'd like, although I always caution doing that because it's an oversimplification. But what you're seeing here is essentially bond market volatility. Imagine it's like the VIX for bonds. And what you can see, and really all I'm trying to point out is this here. You can see we had a sharp rally in bond market volatility over the past 2 weeks. And it's not like we're breaking above the November highs of last year, but we are breaking above the January highs so far. So if you were to go into this a bit closer, so this is certainly something to watch because bond market volatility doesn't have to, but it can spill over into the equity market volatility. So we need to keep that in mind. So that's number one. Speaking of equity market volatility, we talked about this last week, and we mentioned that, once we get above the sort of the 16, 17 level in bond market volatility, we first go into sort of a more choppy period of the equity market, which is kind of where we are right now. So we're no longer in a simply bullish bond equity market, which typically is, VIX 17 and below, or maybe 16 and below. It depends a little bit. We're now, firmly above 17, and we went as high as 21 last week. And so we're in this kind of choppy period. So in order to be outright bearish, we probably need to see the VIX above 25 would be my guess, maybe even higher. And we're not there yet, right? That doesn't mean it can't happen. Of course, we do have concerns about the market near term, but that's, kind of where we are. So if you kind of envision the VIX in three sort of pockets, we have again, I'm going to say 17 and below. Again, it could be 15 and below. It depends on the market environment. So that's one area. Then you've got again, roughly 17 to maybe 24, 25 area. That's the second box. That's where things are choppy. And then you've got the essentially outright bearish area, which is, anything above, let's call it 25 or so, or 30 or so, or thereabouts, right? So we're in the choppy period, in which, of course, without sounding too obvious, I'm sure you guys have noticed, and we've talked about this now for some time, the S&P 500, we've talked about it for months and weeks and weeks and weeks and several months. We are in the middle of a choppy consolidation period. And, this is also where we do think that this volatility intraday is going to spill over into the daily charts before long. Maybe this week. This week is a big week potentially. We've got potential tariffs coming into action. Maybe, we don't know. Maybe they get taken off. Again, it's a very fluid situation. I think it's more or less impossible to forecast, but I do think it will happen that we see more volatility on the daily chart. So far, the volatility is largely being confined to intraday as far as the broader risk assets are concerned. So those are a couple of things that we are watching very closely. And again, I would caution getting too bullish here. I would caution getting too bearish here, because we are in this choppy zone. So hopefully this is giving you some perspective. Would love some feedback, as always, if this is helpful. If it's not, I'm sure there's other places that will give you more definite answers and guaranteed results, which is illegal and unethical and certainly non-compliant. But here we like to play by the rules, and we like to give you an honest analysis. So that's what we're really trying to do here when we do our morning show. So let's go on and move on to a different asset class before we come back to equities. And I want to show you a chart that I think is very interesting. If you guys have probably noticed that the price of gold continues to hold up very well. And I think a really good way of looking at gold here is by comparing it to the S&P 500. So if you look at the price of gold versus the S&P 500, and you look at this on a weekly chart, multi-year, the price of gold continues to hold up very well. It's not like it's breaking records in relative terms, because the S&P continues to hold up, as we just showed you. But we are seeing, pretty impressive relative strength on the price of gold. We think gold can still do well in this environment. We think gold miners too. So I'm watching this very closely. If gold starts to outperform the S&P, then on a weekly closing basis, then this would be a pretty big signal, because I think then we could start to see stocks go down, gold go up, but that relationship isn't very clear yet. So again, here too, a lot of stuff to watch. That said, me personally, this is not advice, just me personally, I'm long gold. I've been gold for 18 or more than 18 months now, and I'm very happy with it. I'm going to remain long gold. We're just looking to go a bit more into the riskier parts of gold. So we actually added gold miners to some of the portfolios last week, after having taken them off a little bit before, because we're seeing some more risk on movements there. So that's gold. going back to the S&P 500 quickly, I want to share with you a couple of levels that we are watching that are logical in our view, both from a psychological perspective as well as from a technical perspective. And so what we can do here, the 5 and 10% down drawdown marks are pretty relevant in the S&P because it has a lot of psychological impact, because everyone in the United States is essentially allocated to the S&P 500, in terms of risk metrics. So what we could imagine is that if we look at the election, a U.S. election, which was November 5th. So I think if we were to break below 5,800, which is roughly, and this is not that coincidental, where we bounced on January 13th, that's a pretty important level. Maybe even a bit lower. Maybe it's 5,700 is a pretty good level. So I think 5,700-ish is a pretty important level to watch. So that's this line down here, because if we were to break below down there, you have a U.S. administration that I think is quite focused on the equity market, and we'll see if that holds true. We don't know yet 100% sure, but once it breaks below there, they can no longer say that the stock market is up since the Trump administration is in office, and we'll see if that matters. It psychologically makes sense to me that would matter. But at some point, when the market starts to become a self-reinforcing mechanism and machines sell, they may no longer be able to hold the market. Remember, the markets are way more powerful than anything. So they will be able to, push sort of political rhetoric around. But we need to watch this very closely. And it also, as you can see, it lines up with the red line on the screen, and that's a 200-day moving average. So if that were to happen and we were to bounce there, that would be about a 7% drawdown. I think 7% is laughable. I think 10 to 15, 20% is where we start talking about meaningful reversals. But we remain in a market that is extremely orchestrated and extremely, the algos still believe in all the bullishness and all the narratives. So we need to respect that. That's my point, right? We don't want to get crazy bearish. But I think that's a level we need to watch very closely. If we were to get down there, 5,700, that would be a level that, I think that's a crucial level. So maybe that's important, and hopefully that is helpful for some of you guys as well. So that's the third thing. So we talked about bond volatility, maybe potentially moving into the equity volatility. We talked about levels in the S&P. We talked about gold, which I remain personally bullish on. Again, not a recommendation, purely educational. And then the last thing I want to quickly go through is financials. I was looking at the market rover over the weekend, and again, I worked through most of the weekend to come into this week pretty much exhausted already, but I'm sure I'll regain my energy. And we noticed a whole bunch of bullish setups in financial stocks. Now, to put this into perspective, this is our market. If you don't have the market rover, go get it. Like, it's just, you're not going to want to live without this once the volatility really kicks up. But you can see the sectors, for example. So the financial sector, which each sector and each ETF and each stock it has a ranking, both from a trading perspective and from an investment perspective. Is it bullish, bearish, neutral, both in the long term and the near term? And so the financial sector, you can see, is now bullish for 325 days, and it had its latest buy signal from a trading perspective 28 days ago. It's now reached target number 1. It looks like we're going to possibly go towards target number 2. But it remains very bullish is my point. And so when I saw, trading buy signals like an Aflac fire off on Friday, or Allstate, these are stocks that are insurance companies, obviously, within the financial sector. And so that continues to hold up very, very well. And so we like to focus on that area. If you are an Inner Circle member, be on a lookout for a potential trade alert on that by email going out a little bit later on this morning. So that's what we have here. And then someone I saw before was asking about Bitcoin. So look, we rank Bitcoin as well in terms of trend and trade. Bitcoin remains very bullish from an investment perspective. In the near term, it's actually choppy. It's not yet in a new bullish momentum move. So we saw a big movement, of course, over the weekend in Bitcoin. There was a tweet by President Trump that he is going to, that they're going to work on a strategic crypto or Bitcoin reserve, whatever you want to call it. And that, of course, gave a big rally to Bitcoin right back to where it was before it started selling off 1 week ago. So it remains a very fluid situation. To me, Bitcoin remains in a choppy range from a trading perspective. It's long-term still in a bullish trend. That hasn't changed. I personally am not looking to get involved here from a trading perspective. I own Bitcoin, and it's a diversification thing that I bought about 5 years ago. I bought some Bitcoins, and that's it. So, and some Ether, or Ethereum, but I don't think there's a meaningful trade set up here. We need to see more momentum come into that from a momentum perspective. And for those of you guys that use the TST Trender, that'll be the way to keep track of that. So that's it to start the week here, folks. Nice sort of brief 15 minutes here to kick off the week. If you are new here, what this is it's our morning show. It's called Set the Market. We spend 10 to 15 minutes going through the most important thing on our radar in the markets. Hopefully this is giving you value. Please, very important, please give us a thumbs up, please subscribe to the channel, spread the word, because otherwise we can't continue doing the show. It's very important, and also it's important so that you get updated in real time when we go live Monday through Friday, through Thursday, and when we go live in special situations as well. So that way you're updated right away when we do that. So that's it, folks. Thanks for being here. We'll see you guys over in the chat room in about 10 minutes, the Trade Ops chat room, and back here tomorrow morning at 9 o'clock Eastern time. Thanks so much. And again, please subscribe and share the morning show with anyone that you could possibly can. Thank you.